Hello, today is Sunday, September 4th, 2022. It has been 5 months since my last money vlog. It's high time for another update. I would like to talk about what has happened in the last few quarters, my outlook for the economy, and of course, how I have been investing. Remember, this is a recording for myself to reflect on my decisions and so that I can understand why I did what I did in the future. Get started. Well, the last few months have been difficult. The stock market is down quite a lot, and I'm happy to say that I actually predicted this correctly. Because in my last vlog, I said that I'd expect asset prices to fall because of rising interest rates, which are aimed at reducing 40-year high inflation, and that is exactly what happened. What I did in anticipation of this was that I sold all my shares in AbbVie. I had bought 13 shares for £1,253 and then sold them on April 13th for £1,655. That's a very nice gain of 32% or £402. I'm very happy I did this because just a few days later, the share prices started dropping and haven't seen these highs again since. I would even say that this was the best investment decisions I've made so far, because just making £400 in a few months just with a few clicks, kind of nice. Okay, let me mention those elevated inflation numbers briefly. In the US, we got CPIs of 8.5% in May, 9% in June, and 8.5% in July. In the Eurozone, we had inflation of 8% in May, 8.6% in June, 8.9% in July, and 9.1% in August. And in the UK, get this, inflation was reported as 9.1% in May, 8.2% in June, and 10.1% in July. That makes the UK the first developed economy to reach double-digit inflation. I also saw a very scary report from Goldman Sachs saying that inflation could reach 22% in the UK next year. So like I said, the Fed has embarked on its fight against inflation. And to be precise, the Fed hiked interest rates on April 21st by 0.5%, then on May 4th by another 0.5% to 1%. They increased the rate by 75 basis points on June 15th. That actually surprised the markets quite a bit. The fund rate was then at 1.75%. And finally, they raised rates again on July 27th by another 0.75% to 2.5%, where the Fed funds rate stands at the moment. These hikes then caused the dollar to go up. The dollar index rose from about 95 in April to 105 in mid-July, and it caused stocks to fall quite a lot. So let me give a few examples. The Dow Jones went from 35,000 in April to about 31,000 in mid-July, down 11%. The UK FTSE dropped from 7,600 in April to 7,000 in mid-July, a decline of 7%. And the German DAX went from 14,500 in April to 12,500 in mid-July, a drop of 13%. But even worse than the performance of these averages was the decline in many individual stocks, especially speculative tech stocks, which is also something that I had correctly predicted. The ARK Innovation ETF, for instance, went from $70 in April to $45 in mid-July, minus 35%. Bitcoin got halved in price from 40,000 in April to 20,000 in mid-July. And one of the most high-profile names that was in the news is Netflix. That stock fell from $380 in April to just $175 in mid-July, down 54%. What did I do during this time? I have managed to continue to put aside £500 every month for the last 5 months to invest. It wasn't always easy, and I had to forego some things, but I have arranged my affairs in quite a frugal way. I cycle to work. I'm renting a cheap apartment. I don't have any expensive hobbies. So I've been able to do this so far. I put all of my money from April to June into more gold stocks. In April, I bought E2 Gold with my sales from AbbVie. So that was about £1,500. In May, I bought £1,000 worth of Barrick Gold, and in June, I put my monthly £500 into Gold Fields. Unfortunately, these were all terrible investments, just awful, because of the higher US interest rates and the higher US dollar. Gold prices fell a lot. They dropped from $1,900 in April to under $1,700 in mid July. And this then completely crashed the gold miners. I have huge losses in my precious metals mining shares. So after these substantial declines, the market seemed to expect a pause in the hikes. I heard on the financial channels lots of investors who said that the Fed would wait and that they would cut rates in 2023. Or we just had all this wealth destruction, or people say demand destruction. And also the US GDP numbers came out weaker than expected. They showed two back-to-back declines. US GDP shrank by 1.6% in the first quarter and by 0.6% in the second quarter. So it looks like there's going to be a bit of an economic downturn. And in this crazy world where bad news is good news, investors were hoping for easier monetary conditions, and we had a big rally into August. Again, a few examples. The Dow Jones went from 31,000 in mid July all the way to 34,000 on August 18th. That's an increase of about 10%. Bitcoin recovered from 20,000 in mid July to 24,000 on August 15th, a 20% rally, and Netflix rose from $175 in mid July back to $250 on August 15th, up 40%. So that was a spectacular rally. My own investments during that time were that I bought a company called Sims Limited. That's in July, and they're an Australian scrap metal recycler. That's sort of part of my environmental and renewables portfolio. And I also bought more gold, 500 pounds worth of shares in Newmont in August. Newmont, who are the world's largest gold producer, have completely imploded. Their share price has dropped more than 50% since April. I'm a bit angry about that and stubborn, and so I decided to double down and buy even more. I also sold a company called Woodside Energy. They were a spin-off from one of my commodity stocks, BHP, and I immediately sold them when they became an independent company because of my commitment to avoid any fossil fuel companies in my portfolio. That's quite unfortunate, of course, because oil and gas are just about the only asset that went up in price over the last few months. And the war in Ukraine and the cost of living crisis are, of course, apart from inflation, the most important, most common keywords that you hear in the financial news. So fossil fuels is the only area where I could have made money, but I refused to do so, I guess you could say, on moral grounds. So except for those, about 50 pounds windfall that I received from selling this new spun-off energy company anyway. Okay, so we just had this impressive rally in the stock market, and interest rates in the US stand at 2.5%. My thoughts were, and I think they're sort of interesting, that the increase in the stock market and the general optimism that you found at that time is the source of its own undoing. Because as long as the economy doesn't suffer in noticeable ways, and as long as the stock market keeps going up, or at least doesn't crash, central banks are free to continue to raise interest rates. Or in other words, there simply hasn't been enough economic pain yet. Those stock declines of 10% or even 20%, they're just not bad enough relative to the importance to bring inflation down. In this respect, I should also mention the overall strong jobs reports that we have seen coming out of the United States. The US reported 428,000 new jobs in April, 390,000 jobs in May, and 293,000 jobs in June 2022. Then the July numbers came out and blew everybody away. 528,000 new jobs, the unemployment rate at 3.5%. That's the lowest rate in half a century. Employment back to pre-pandemic levels. And all the news networks all said that this shows resilience and they were optimistic and that we have a strong economy. August, that was just 2 days ago, saw And I have heard it described as a Goldilocks report. 315,000 new jobs, not too many, not too few, just right. So the jobs reports also give the Fed enough confidence to continue with their tightening policy. And finally, I believe the Fed also wants to raise interest rates to reduce the excesses in the market. The moment we got some hopes of easing and a rally in the stock market, we also saw a resurgence in crash speculation. The best example of this is what happened to Bed Baths and Beyond. This is a company on the brink of bankruptcy. It now turned into a meme stock that went up 500% from $5 to $25 in 1 week. I read a story about a 20-year-old student who allegedly made $100 million on this. So this is a sign of craziness, of a speculative mania that needs to stop. And the Fed should, and probably will, break the back of this casino mentality at the stock market. So Fed Chief Powell gave a long anticipated speech at Jackson Hole, and it was incredible. It was very short, 8 minutes, concise, and perceived as very, very hawkish. He completely spooked the markets. He said he wants to keep raising interest rates. He would accept softer labor markets, meaning higher unemployment, and he would expect pain to households and businesses. Oh, wow, that was quite a speech. Markets fell, and that's where we are right now. Now, I've heard many different views on where the economy is headed next. My view from the last vlog has not fundamentally changed. The only thing that's changed perhaps is my timeline. I thought that when interest rates reached about 2.5%, where we are now, we would see substantial negative consequences, and that would then usher in changes in monetary policy. Instead, apart from a slightly falling stock market, not much has actually happened. And indeed, there are a lot of voices out there that say that what will happen is that inflation will come down, but the economy will not go into a severe recession. This positive scenario is often referred to as a soft landing. This sort of benign scenario actually is the consensus right now, I would say. For instance, we can see this in the inverted yield curve. The 2-year US Treasury note yields 3.5%. That's higher than the 30-year note, which yields only 3.4%. So the market anticipates increases by the Fed of 3.5% for the short term, but thinks that in the long run, inflation will come down again to about 2% or whatever, hence the relatively low long-term rates. I've heard one investor who said he predicts interest rates to go to 4% and then stay there throughout 2023 without an overly negative impact on the economy. Now, I really wish that optimistic view was correct, but that's just not what I believe. I'm much more bearish. I think it is simply taking a bit longer than I had thought for the negative consequences of higher interest rates to emerge, but not that we will actually avoid them. In fact, I believe that even 2.5%, so where interest rates are right now, is already more than the US economy can handle. And since interest rates will go even higher from here, the economic downturn will likely be even worse. What we are headed towards, I think, is not just a run-of-the-mill recession. I think it will be extremely severe, game-changing, a super recession, and worse than 2008. Not a consensus view, but some people actually that I've heard share this view as well. So it's not completely outlandish. So in the next few months, I think we will witness toughening conditions in the following way. First of all, the stock market will fall again. In particular, the risky, speculative end of the spectrum, tech stocks with no real earnings. For instance, this famous ARK Innovation ETF, I think that could be cut in half over the next 3 months, so from $40 to about $20. Similarly, I think Bitcoin will fall another 50% from $20,000 to $10,000 in the next few months. And this time around, what will be different is that it's not just expectations of higher interest rates that drag stocks down, but real facts, lower earnings, lower profits, Consumers have less money, inflation is squeezing them, so they just can't afford, another streaming service, another Fred, or a vacation, or to subscribe to some cloud computing service or whatever. Then companies will cut back on their spending and lay people off. And who knows, there might actually be some high-profile cases of business bankruptcies. So unemployment will rise, and that's what Powell said. The Fed wants softer labor markets. That means higher unemployment. And as the saying goes, don't fight the Fed. So this is exactly what's going to happen. By the end of the year, I'd say unemployment will be between 4 to 5%. Then housing will show bigger cracks than it has so far. New housing projects will likely be reduced. Housing prices may finally fall because people can't afford those higher mortgage rates. And I also think there will be substantial layoffs in the housing industry. And also housing-related spending on, furniture, on renovations, on gardening, that will also be reduced. This, I think, will hurt the middle class far more than falling stock prices, because for most families, their house is their biggest asset. Maybe that's what Powell meant when he mentioned pain for households, is actually in his speech. But I think the most important new development that we might see in the news may be about government debt itself. That is very, very high. For instance, it's $30 trillion in the US. And so there is a risk that rising interest rates might make it difficult for governments to afford this debt. Also, the main reason why the ECB started lowering interest rates and buying government debt in the first place was to subdue the European debt crisis of the 2010s. So the moment they raise interest rates, this old wound would open again. So going back to my personal investments, with this view in mind, I decided to put my £500 for the month of September into a stable, defensive, dividend-paying stock. And so I bought more shares of Tesco, which is the largest groceries retailer in the UK. And they pay a dividend currently of 4.4%. I like Tesco. I think they have the best meal deals. I even have their club card. And I think they'll be able to pass on higher prices to their customers and, navigate the storms of the coming recession in that way. Now, originally, I thought that all of these problems that are associated with high interest rates would happen quickly and then lead central banks to abandon their tightening this year. Seeing how long everything is taking to play out, though, I don't think we will see this pivot in 2022 anymore. Although we might, who knows. And now I think this sort of capitulation will happen next year instead. My view is that there will be a recession, and like I said, a severe recession, and that inflation will still be uncomfortably high during this recession. So it will be an inflation recession. Some economists I've heard actually say that a recession will take care of inflation in and of itself automatically, but I just don't really buy into that. If that were true, you could never have stagflation or inflation during a shrinking economy. Of course you can. It's happened many times before. So I think it will happen this time as well. So how and why might this pivot happen, and why will inflation still? Well, I think there will be pressure from politicians. They want to ease the pain that households feel through spending. There has always been tension between central banks and real politics. Donald Trump famously pressured Powell into cutting rates. And indeed, right now, there's a discrepancy between monetary policies with rising rates and fiscal policy, where governments keep spending more money. Biden announced a student loan forgiveness program recently. The US also passed a new $737 billion law. And just today, just a few hours ago, I read in the news that Germany has decided on a new inflation relief package of 65 billion euros. Also here in the UK, the planned tax increases have been taken back. And Liz Truss, who will most likely be the new prime minister from tomorrow on, has said she wants government measures to help people with this cost of living crisis. All of this costs a lot of money. All of this contributes to inflation. And so we need central banks to enable this sort of spending. I can even kind of imagine the rhetoric that this will lead to in the future. Once we have a recession, officials might say, look, we need to help people. We need to create jobs. That's much more important than just inflation. Maybe they'll say inflation is just caused by supply shortages. So we need investments to produce more. Or we have to protect the poor. All kinds of political reasons that people might list why we need to ease monetary conditions and keep spending. Hard to say how exactly central banks will justify their decisions, but I think something like this might be in the cards. Also, supply chain bottlenecks will continue. Deglobalization seems to be a trend that is becoming entrenched. War in Ukraine will continue. Just this week, we learned that China will lock down the city of Chengdu, which is a city with more than 20 million people where they produce a lot. So these problems are all severe, they're all inflationary, and they're here to stay for a long time. Now, I don't like any of this, but that's how I see the most likely outcome for the future, and that's therefore how I will invest. Like I said before, we can't really raise interest rates. Yes, they have risen to 2.5% in the US now, but we are in the very early stages of this process, and it will become obvious soon enough that inflation is here to stay. And if that's correct, then that should be good for gold. And that's why I have continued to buy these precious metals miners. But perhaps the most important reason, and it annoys me beyond belief that this is not a bigger topic on the financial news. It should be the number one most important topic every day. That is climate change. This is not just a reason for next year, for 2023, but much longer term. But so I must still list it here. 2023 might be the beginning of a recession, but it will not be over in 2023. No, this economic decline will last for years. And if we don't get our act together as a species, it may never stop. We are facing resource depletion, water and food shortages, billions of dollars in damages. Climate change is, I think, the single biggest challenge that humanity has ever faced. And it is a travesty, frankly, that the financial markets, the core and the most powerful allocator of resources in our society, isn't more responsible with it. So I've even seen financial commentators who are outright climate deniers. So what I will present in the end now here is just a few natural disasters, only those that I have sort of deliberately engaged with that are related to climate change from the last time I made a vlog to today. So May, there were sandstorms, which are exacerbated by desertification and reduced rainfall in Iraq. There were big forest fires in Siberia with temperatures that are much too warm for that region. A highway bridge collapsed near Kashmir due to a burst lake that held glacial meltwater. California saw its lake Oroville at historic lows. And once again, wildfire season began earlier than normal. There was a triple tornado in Germany, a major flood in Bangladesh, and Morocco's hottest ever day in May. June, we saw golf ball-sized hail come down in France amidst record temperatures, severe flash floods in Florida, roads collapsed in the Yellowstone National Park because of unusually severe downpours. Thousands of cattle dying cancers from heat stress. The megacity of Guangzhou in China experiences devastating tornadoes. Forest fires in Brandenburg in Germany, for which the probability has demonstrably increased over the last decades. The Po River in Italy has entirely dried up in places. Forest fires in Spain. Deadly flash floods in China's Guangdong province. Baghdad sees multiple days of above 50 degrees centigrade temperatures. Water rationing is introduced in southern France, and Pakistan is hit by one of the worst droughts ever. July, New South Wales in Australia experiences terrible flash flooding just after it had flood earlier in this year and after it experienced severe droughts and wildfires 1 year earlier. A deadly avalanche at Mountain Marmolada in Italy kills 19. The summit had been at record high temperatures just before. Japan experiences its worst heatwave ever recorded, with Tokyo above 30 degrees centigrade for 9 days in a row. The Great Salt Lake in Utah reaches its lowest level on record. Europe is experiencing a devastating drought. The UK is recording its hottest temperature of all time, with the first time that temperatures rise to above 40 degrees centigrade in that country. Temperature records in Brittany, 39.3 degrees, in Nantes, 42 degrees, with large forest fires in France, Spain, Portugal, Italy, Croatia, Greece, and Morocco. Texas experiences a heat wave after it went through its hottest May and its hottest June on record. Water shortages in South Africa, large wildfires in America's Southwest, hottest day on record in Hong Kong, and Lake Mead is at only 27% capacity. August, flooding in Kentucky. The Rhine River is so low that shipping is impeded. A terrible famine in East Africa takes on ever more drastic dimensions. The Loire River in France is dried up. A big flood happens in the South Korean capital of Seoul. The Yangtze riverbed in China is exposed. The Swiss glaciers have now lost 50% of their ice. And finally, an unprecedented flood sweeps over Pakistan, killing thousands, leaving 30 million homeless and 1/3 of the country underwater. These disasters will get worse, and in the long run, they will have severe negative inflationary economic impact. Okay, finally, let me summarize my portfolio. As of today, it has a market value of £28,061. This corresponds to a substantial loss of 18.1%. The upside, I have received £469 in dividends between January and June for a yield of about 3% on my portfolio, which I think is pretty good. Right, so on this cheerful note, I'll end this recording. Hopefully, I'll be in a better mood for my next update, and maybe I'll have some better numbers to report then. Until next time, bye-bye.